there was a change in the law in Switzerland as a result of which, if you're an asset manager, you have to apply for a license. And as part of our license application, you have to be 2 people. And, it's easy to complain about regulation, and a lot of it is very frustrating. But I think on this point, having 2 people, especially after what happened in the summer, is for sure a good thing. When I introduce it like that, it sounds like it was done out of necessity rather than out of desire. And I can say it was certainly something we should have done a very long time ago anyway, or in fact, in many respects, already were doing. We're very old friends. I think we met in Omaha for the first time.
We met in Bari in Italy.
In Bari even,
yes.
yeah.
That was in 2000 and... No, sorry, not in Bari. It was in Zurich at a common conference that a friend of us, Norman Rentrop, organized.
Yeah.
It was a get-together of 20 family offices, and I was quite excited to be part of this group. And this is where I met Rob, and we stayed in contact ever since.
Yeah, and we've visited companies together many times over the years, exchanged views. Andreas is probably the person I've most often talked about stocks with. And so really, Andreas joining was just a sort of a natural extension of kind of what was happening anyway. In terms of how we work, Andreas is himself a very successful and passionate capital allocator. He continues to manage his money. I continue to be the advisor to the business owner fund. And we make our investment decisions separately. Sometimes we see things the same way. Sometimes we see them differently. But what we always do is enjoy visiting companies together, talking about them, exchanging ideas, and that's really the way we've worked in the past and how we continue to work in the future.
Yeah, exactly. It's very exciting and very pleasing to work with Rob. He's a great person to talk about businesses, to talk about investments, to visit companies. He's a great at judging management, and it's really a great pleasure to work here and also to share in the administrative work a bit, which has certainly increased since the regulation came about.
Yeah. So for those of the participants that weren't here 3 years ago when we did the fireside chat, maybe 2 or 3 sentences on who you are.
Okay, I was basically a passionate investor out of high school and built my family wealth through investing, and I was always more or less a private investor. Moved to Switzerland 10 years ago, and so I live very close to Rob. And a couple of years ago, I set out to start my own business. But the regulation being as it is, it turned out to be make much more sense to team our forces, since we anyways work closely together at analyzing companies. And so why not go for one license together instead of each one of us hiring people.
Yeah. And you joined actually on the 1st of July, and it was only a couple of weeks later that I, had the medical emergency, which you all know about. And Andreas was in the hospital with me. I think from the first day I was taken in, and an incredible support to me emotionally, not just as a friend, but also knowing there was someone there to keep the bills being paid, making sure the business kept on running. So, an enormous thank you to you for that.
Yeah, you're welcome. My pleasure. I'm very glad how it all turned out.
Okay. Well, last year was a very tough year, and I don't want the impression to arise that we're trying to run the clock down. Oh, is it 12 o'clock already? No, it's a tough year. We can't change what happened last year, but we can answer your questions. So Olivia and Tommy are here with the mics and are looking forward to handing them out to you. Who wants to go first? Paolo.
Hi, Rob. Hi, Andreas. A quick question regarding AdLife. I've seen that the CEO has recently changed, and I just want to ask you what is your take about this change. And the other thing is the stock price has gone down quite a lot from the high. And so what is your feeling now in terms of valuation of AdLife?
Yeah, so I think when I invest in a company, what I'm looking for is people who are turning, who want to make that company their life's work. And so what shouldn't happen is that the CEO steps down after a few years. In the case of Christina, it was after, I think, 5 or 6 years. So I'm disappointed by that. And it's happened actually in 1 or 2 of the other companies I'm invested in as well. I don't think it's because there's any problems at the company. I think it is connected, though, to COVID. It was a traumatic experience for many, many people. When I spoke to Christina afterwards, she said, she's at a stage in life where she lost her mother. And so it caused her to kind of rethink, okay, with the time I have left, potentially, what do I want to do with my life? And I think a lot of people in COVID decided there were, things they wanted to do differently. And so I was very sorry to hear it. But I understand her reasons completely, and I think she did a fantastic job. And we remain in contact. And if she's watching this, wish her really well. And in terms of the share price development, I think there's a couple of things. The company had just an incredible run during COVID. They sell COVID tests. So you can imagine they had a really big boom. So the earnings sort of went into really shot up a lot, and at the same time the share price did as well. And I think there's been a coming down to earth over the last sort of year or so, where the earnings growth has come down. Probably people's expectations of growth have come down, and some of the sort of some of the sort of frothiness in the share price has also come down as well. With the benefit of hindsight, it would have been a company which I should have sold when the share price was close to its highs. And in fact, I did sell, I think, approximately half of our position. But in terms of the business and the people running it, it's a great business, and I remain convinced by it. Andreas, anything you want to add there?
I have no comments on that live, nothing.
That reminds me of somebody. Okay, there's Cassandra. Hi.
Yeah, hi. I was wondering, of course, with some companies you have closer contact with management, and management is, of course, an important consideration when you make an investment, or at least if they're good quality people that are running the businesses. I was wondering if you both perhaps could shine some light on how you interact with management of course, when they change, but also some portfolio companies are really large. Maybe you don't have contact with senior management, but do you have any contacts at these companies? How do you build on those relationships? Do you need those relationships?
Yeah. I wouldn't necessarily say need, I would say love. One of the things that motivates me, and the reason I'm sitting here today, is the relationships that come about through investing, and that's, of course, partly with my investors. It's with, of course, all of you people here today. But it's also with the managers that run the business. I find managing a business a fascinating and fulfilling job to do, and getting to know those managers, hearing the problems they encounter, how they solve them, the successes, the failures. That's a journey I love to go on. And the question that sometimes comes after I say that is, well, how do you maintain your objectivity then if you're so close to these people? And of course the response is, well, I'm probably not particularly objective. But I don't think that's always such a bad thing. People are not objective when they choose a spouse, a career. These are all very subjective things, and I think sort of passion, on balance, is very additive to that process. But maybe you could talk more about our sort of interactions and stuff.
Well, we usually meet a lot of managements in conferences, in visits to headquarters, and we want to visit every manager, every CEO, every management team that we invest in. There are exceptions. If it's a huge company, obviously they will not want to see us. It's not 100% required, because when a company is big, you usually find enough public material on YouTube where they were interviewed. And so I think it's very important to make sure that your own vision as an investor of a company, of where the company should go and why you invested, is in coincidence with the management's vision. And there's no other way than to talk to them to find that out. So that's why we want to really visit all of them, and with some exceptions apply. Yeah, that's how we think about it.
And I think on the really large companies, like for example Facebook, there's plenty of videos and interviews with Mark Zuckerberg out there to see how he thinks about it.
Exactly, yes. So you want to know what the vision of the management is. I've learned it the hard way. I've had one investment in a Norwegian company that had two business areas. And I was actually invested because I thought highly of one of the two business areas, but management thought vice versa and sold this one business area for a quite cheap price. So, yeah. But they didn't take my calls, so I shouldn't have invested in the first place. It was a rather small company, and they didn't take my calls, and I couldn't make sure that both of our visions were aligned. So.
Who's next? I see someone at the back with
Hi, Rob.
Hi, Pratyush.
I have the mic.
Hi.
So hi, Andreas. So it was a tough year last year for stock pickers in general. And when you have a large drawdown like last year, there's some math that goes behind coming back to what you were, right? So if you're down, whatever, 50%, it's not like you can just go up 50%. You have to double to get back to where you were. Do you think about that? Is there a plan on how you might do that, and not maybe necessarily a plan, but how you think about what you might put into the portfolio or take out of the portfolio?
Well, Andreas is our resident mathematician. Won a lot of prizes for maths at school, if I remember correctly.
Yeah, that's true.
So you could take the mathematical part of that. In terms of how I'm going to manage the fund, I'm glad the question came along. It was a big drawdown, but it won't change how I'm doing things. There'll be no risky bets in order to try and win back what was lost or anything like that. My aim when managing your capital has always been to try and compound it at a decent rate. My goal is always 15%. That's an aspiration as opposed to a promise. And it's still 15% a year. And if it's more than that's great. But I won't stretch for more than that just because we had a big drawdown last year.
Yeah, and actually where the portfolio was at some prior point in time should not influence your investing strategy. You should, at each point in time, make one rational decision after another. And even if you made a mistake in the past, you have to move on and not make that mistake again. But you shouldn't invest in a different way just because the portfolio was 100% higher maybe a year ago. So in that sense, I think Rob will continue managing the portfolio.
I think I got a mic.
Just lift a hand, I can't see where you're going.
Yeah, here, I'm here.
There you go, yeah, hi.
I'm here to give you a little bit of time to breathe for the difficult question. I have a completely different direction. If you would start over again, totally like without a fund, with your private money, would you invest anything different style, like a focus on smaller companies, nets, or even special situations? Yeah, basically that's the question.
Yeah, thank you. I think we see this quite similarly. You see a lot of literature around how there's more market inefficiency in smaller companies than large companies. We just disagree with that. There's plenty of very smart people following small companies, and there's plenty of smart people following large companies, and we don't see any structural inefficiency. Now, of course, things come and go in cycles, and at any moment in time, it might be the case that large cap is very out of favor, and of course, vice versa can also be true. But we're pretty agnostic about whether we invest in large or small companies.
It's about the quality of the business, not the size. And in fact, large companies can be as inefficient as small ones. One of my largest investments is Microsoft, and it's been so for 12 years. I've pitched the idea to many other asset managers. I've pitched the Microsoft idea to many other asset managers, but they tell me they cannot put that in a portfolio and collect fees on that because it's a too simple idea. and I think that by itself creates inefficiency in such names.
The one thing I would say, we've got Jacob McDonald here, and so I think this will be a good topic for tomorrow, but he wrote a wonderful book about Buffett's early investments, and Buffett was focused on these sort of quite smaller companies with a lot of cash in them, and but let's save that discussion for tomorrow.
Yeah, I would have a question. I'm wondering how you last row. I'm wondering how you're thinking about position sizing. Do you use the Kelly criteria on half Kelly, or do you say, okay, I'm starting out with all equal weight? How do you think about rebalancing positions? Do you do that? Do you trim positions at all? Yeah, that's my question.
Yeah, I mean, I think our portfolios are quite similar. We both invest in a very concentrated way. So the business owner fund has typically had roughly 10 companies in it. Maybe sometimes it was 9, sometimes 11, but it was always around about 10. And I was self-taught as an investor, and when I started investing my own money, I only ever had 10 companies. Because it's difficult to know more than 10 companies really well, and of course, to invest in 10, you probably want to analyze at least 50 or something. So just from a sort of just from a logistical perspective, it would have been difficult to invest in more than 10. But also, like when you're investing your own money, and especially when you're younger and maybe you don't have so much money, when you have a really good idea, you want it to make a difference to your net worth. So like if you have this amazing idea and you put 1% of your capital in it and it goes up 3 times, then congratulations, you've got a 3% return. You could have got that by investing in cash. I think 10% for me has been a good sort of level where it can really make a difference to the performance if a company does well. But the flip side is if a 10% position goes to 0, which shouldn't happen too often, but even if it were to, it would be a mistake you could very easily recover from.
I may add one thought about the Kelly criterion. I mean, the Kelly criterion is just a mathematical concept that applies to a situation where you have a strictly defined game. Let's say you're flipping a coin and the game is beneficial to you. You have a slightly positive expected value and a certain variance, and then you can say, okay, what is the optimal betting size with each game so that the capital grows as fast as possible. And you have no risk of getting a 0, or very little risk of getting a 0 because you lose 10 games in a row or something. But you don't have these clearly defined circumstances in the financial market. You have a rough idea what the risk of each company is, but it's not clearly defined that you say you have a coin that has a 60% probability of, let's say a 50% probability for each side, but a slightly higher outcome on one side than on the other, where you can really calculate the outcomes. So I wouldn't say this really applies, but just qualitatively speaking, the higher the risk, the lower the allocation should be. And another thought on the diversification, many of the companies that I own and also Rob owns have more than one business. I mentioned Microsoft before. They are intrinsically diversified because they have Windows, they have Office, they have gaming, they have LinkedIn and Bing, and so they're in Azure, of course. So there are so many businesses inside Microsoft that I would say they count as more than one position. So I personally would go below 10 positions if the ideas if I don't have 10 good ideas. I would rather have fewer ideas than more ideas which are mediocre.
Question from the internet.
Let me just take the opportunity to introduce Nick. Nate has been our resident question asker from the internet for the last years. Quick applause for Nate. He's kindly handed the baton over to Nick. So Nick, thank you for taking that over.
Very dangerous. A couple questions on Ryman, and just to summarize, is just your perspective on potentially deteriorating environment with concerns around its debt loads and kind of how you balance the short-term concerns, the move in share price, and your long-term focus on the business.
Yeah, I mean, they're in a tougher environment now. Not sure what the questioner was referring to. You know, there's different parts of the business which are all facing certain challenges. So, you know, the property market prices are declining, as you heard this morning. They're a key beneficiary of the price of, you know, when they sell a property, they make a profit versus what their cost was. You know, the important thing to realize is that if you think about it, from when they sort of break ground on a village to when they sell it for the first time, and from the time when they sell it from the first time to the second time, you know, it's probably, depending on how long it takes to get it permissioned and then built and everything, it's probably about 5 years from the, you know, breaking ground to the first sale. And depending on how long the resident stays in the property on the second sale, it's, you know, potentially about, you know, 6 or 7 years. So we're not comparing. So when Ryman makes a profit when it sells, you know, a house or a unit today, you're not comparing it to what the price was, you know, a month ago or 6 months ago. It's based off of what the price was, you know, 6 years ago or even 10 years ago. And there's just such a huge margin of safety. There's been just such a staggering increase in property values in New Zealand and Australia that, you know, quite a lot more would have to happen before, you know, we got even close to a situation where they wouldn't be making money on those sales. In fact, I think it's almost a certainty on the resales that those margins will continue increasing. And then, you know, another area where they've struggled is on the care side. And, you know, as David said this morning, care used to be very profitable. The government hasn't sort of kept up the reimbursement with inflation. And as a result of that, you know, Ryman has seen a deterioration in its economics. And that's created a lot of pessimism in the market, which frankly I don't share. A lot of the competitors who haven't invested in care are sort of patting themselves on the back and saying, look how smart we are, we're not overly exposed to this area, which isn't very profitable. I think that's idiotic. When you move into a Ryman village, of course you care about the quality of the house and that it looks nice and all that kind of stuff. But ultimately, the service you're buying is access to great care. And the idea that you can sort of arbitrage that need from the market away just by building the houses and not the care is ridiculous, and it's why Ryman is such a great business. And I suspect financially, in the medium term, it will also work out very well as well, because in the same way if you're I see mostly younger people here, so like if you have a family with children and you book a sort of a hotel for the vacation, you pay for the room. You don't pay separately for the pool and the kids club and all that kind of stuff, but it's kind of like a big part of the reason, or whatever price you're willing to pay for the room. And in the same way, you know, if there's no care available in New Zealand or Australia, then people will just pay more for the houses in order to get access to that care. So I think in both respects, it'll work out fine. And in terms of debt, you read in my letter, which I sent out the day before yesterday, that I dislike debt, I hate debt. It was a mistake I made on Carvana and investing in a company which was overly indebted. I don't like to see the debt at Ryman. I've written to the board on several occasions saying I would prefer the company not to have debt. That being said, it's a very different situation. This is a property company with large, very valuable real estate. It's very, very low risk debt from the perspective of the lenders. They have great long-term relationships with the lending banks. So I'm not concerned about that at all, although I would prefer it not to be there. And if anyone from Ryman is watching this or seeing a recording of it, you know, let's lower the debt, please. Anything you want to say there?
No, I have nothing to add, I think.
All right, a quick question from my side over here.
Yep.
Thank you all for having us, Rob. 2 questions.
Thank you for coming. Is it okay just to do one, because there's quite a few, so choose the toughest one and give it to Andreas.
One tough one, one nice one. Okay. So I'm just trying to give you an easy time. Okay. Because looking at when you started in 2008 till now, SAP roughly doubled, investors in your money roughly 4 times the money. How does it feel to know that you provided value in your worst year? And second, what do you think about Grenke?
Yeah, well, thank you for the first question, which was very kind. You know, a big motivational factor for me is helping my investors to solve their financial needs. I have some very large investors like endowments, where the money goes towards education and for underprivileged students, and there's some very small investors where the savings are towards sort of school fees and you know, maybe a holiday home or a first home and all that kind of stuff. And you know, I'm delighted for the job I've been able to do for the investors who were there since the beginning. I'm very disappointed on the experience people have had who perhaps only invested a year or 2 years ago. And you know, I'm going to stay around here for a long time. And you know, this has been a bad year, but there'll be better years. And you know, sometimes one person asked me, I don't think he could have known me too well, asked me something along the lines of, now, you know, the kind of the high watermark for the fund is so far away, you're going to shut the fund down and start a new one. I'm not even going to respond to that. And then on Grenke, anything in particular you wanted to hear about it, or?
Over generally, your opinion about Grenke, overall.
Just overall, you know, it's a company I've been invested in since day one of the firm. I know the company incredibly well. They're incredibly high quality people working there. It's an incredibly high quality business. And since, you know, when I first invested 15 plus years ago, it's been a great investment, and it's still a great investment today. If you look at the last 2 years or 3 years, they've had two, you know, pretty tough setbacks, which, you know, would have killed, I think, a lot of companies. The first one was COVID. You know, they sell to, you know, a lot of like old economy style physical retailers, restaurants, that kind of stuff, the type of business that was really hurt by COVID. So that was a huge body blow to the business. And then just when they were sort of recovering a little bit from the COVID, there was this short attack with short sellers making all kinds of fantastical allegations against the company, nearly all of which have since been completely disproven. So it's had a very rough 3 years. That's why the share price is where it is. But the business is doing fine. And, you know, a kind of, I guess, a glass half empty point of view is, you know, this company's had 3 very tough years. But I think a glass half full perspective is, if you can go through all that and still be around and be profitable, to have lots of capital, then it's a great indication of just how resilient the business is.
Hi, Rob. Here. Asaf from Israel. First, I want to wish you very good health. It's the basis for everything, and I wish you will manage a business owner fund for many, many more years to derive much more pleasure from it.
Yeah, and thank you for making the trek over from Israel with your friends. It's always great to see you.
It's a habit. It's already a habit.
I've been reciprocating. I've been trekking to Israel quite recently as well, so.
So my question is a little bit, I think, unpleasant, but I think it's a must. First, I just want to mention that John Hampton wrote a very nice piece about how he manages mistakes that he makes in the portfolio. For instance, he made an example of a 4% position, hurting the performance like in 15%. When it goes down, he just increases it, and it goes down again, 50%, he increases it, and then eventually a small position can kill the portfolio. So he has a very nice piece how he manages mistakes. So I was wondering, after you realized that Carvana is probably a mistake, so how did you manage? I mean, when the price goes against you, there's a, you know, you can go be a contrarian, but sometimes the market is right and the investor is wrong. So I was wondering, how did you manage the investment in Carvana along the way? I mean, it declined, and did you add? Did you think about selling? I mean, how did you manage this mistake?
Yeah. Thanks for the question. That's a good question. You know, a lot of you have followed the portfolio over many years, and you'll know that every company I've ever invested in has been through at least one crisis or multiple crises where it looks like, you know, there's plausible reasons or people making arguments why the company is, you know, challenged, or in some cases there have been accusations even that some of the companies were fraudulent. And when that happens, there tends to be like a huge drawdown in the price of the company. And that's sort of the moment of truth for us as investors, right? Do you panic and sell, which to the extent the allegations are right, it would be probably a good thing to do? Or do you double down and buy more, which is the right thing to do if your analysis is ultimately correct? And, you know, I'm a contrarian, Andreas is a contrarian as well. My instincts when everyone is against a company and I believe that it's a good investment is to buy more of it. And that's something I've done on multiple occasions, and it's served us very, very well. But of course, at some point, there's going to be an investment that goes down, and it goes down for very good reasons. But there, you know, I don't just keep doubling down. In the case of Carvana, the main position was built in the first quarter of this year, and I think I added a very small amount in Q2. An even smaller amount in Q4, but nothing which was really needle moving. And you know, the situation now is, you know, well, we'll have to wait and see a few more years to see really what the full situation is. But you know, I guess the question is, what does that mean? And it means, although I'm willing to sort of bet against the market, if I think the market has got things wrong, I'm not going to bet beyond you know, an irresponsible level. And you know, Carvana hurt, but it didn't kill us. Yeah. What are your thoughts on doubling down?
Well, I would not double down if it just moves slightly down. But it has to be a significantly new opportunity that you are willing to allocate a lot more capital. So I have had a similar situation, not in Carvana, I'm not that familiar with that company, but with Meta, which we also both own. I initially bought it in 2014 and then added in 2018. And it became a really big position then in the subsequent years as the stock price moved up. And now it's down a lot, but one has to acknowledge that certainly the intrinsic value has also deteriorated somewhat due to all the scandals they've had. And you have to take that into account when you make the decision to double down. So it's certainly a different proposition right now than it was a couple of years ago. Or it was in 2014. Yeah, so I would double down, but you have to make sure that it's really a good price that you're offered, not just double down because you say, I paid double the price a year ago, and it must now be a great value. No, you have to think from zero again and make sure that the story is still intact, and only then add down when you are absolutely sure that this is the best value-adding move you can make to the portfolio. You could also buy some other company. So, yeah, that
makes sense. Yeah. Florian.
Hi, just wanted to expand on your comments about Meta, Andreas, that you've been an investor for a long time. And I remember, Rob, last year you mentioned your basic hypothesis on your Meta investment, and you were very bullish about their prospects despite their heavy spending on R&D, like this 10 billion spending, which you can see little impact on the bottom line so far. Just wondering, over the course of the year, as the share price halved once again, did you expand on these positions? Andreas, did you, and Rob, how are you views on that? And is the basic hypothesis still intact, or are there like any reflections on how the situation might have changed for this company?
You want to go first on that?
Yeah. Well, first, maybe to this 10 billion investment in the... So first, some words on the 10 billion investment in the metaverse. You have to see there is a component of creating credibility to it. Back when they started the metaverse, they wanted to establish a new mobile application platform next to iOS and Android. And you cannot just do that if you're Meta by saying, okay, I let a vice president do the presentation and spend $500 million per year on that. No serious app developer will develop or dedicate people to this new app platform and develop applications when he can just use the same people to develop applications for iOS or for Android. So if you're Meta, you have to show that you're serious. And you show that you're serious by having the CEO do the presentation, by renaming the company, and by saying you spend $10 billion a year. So there is no other way if you want to succeed in that sector. And they have no way of acquiring the leading metaverse play in 5 years because they're not even allowed to acquire some company like Giphy anymore. From a regulatory antitrust perspective, so they have to build the businesses themselves. And it's quite common in the high-tech industry. If you look at Amazon, Google, they have all projects where they invest billions of dollars every year and lose money. Some of them turn out well, some of them don't. So me as an investor, I just set aside, let's say, a reserve of 50 billion for the metaverse, the negative value that this may create over the next 5 years, and in 5 years it's either successful or it's failed. They close it down in 5 years or it's succeeded. And I just approach it from some of the parts perspective. I value the operating business, the core business that they have, and value the metaverse maybe with a negative 50 billion. And I think I'm on the conservative side for that. And yeah. So.
I mean, I'd have to listen back to what I said in March, but I would say on balance, I would say I'm maybe even more bullish today than I was then. If I go back to March, ATT, which was the main thing which has harmed Facebook over the last 2 or 3 years, was already well established. It was clear that was going to negatively impact its cash flow. But I think from the perspective of last March, the biggest fear I had was around sort of TikTok and the potential for TikTok to take engagement away from the Facebook family of apps. And in that respect, I think the market share gains of TikTok have flattened, and I think Facebook is having incredible success with Reels. I saw that it's, I think 20 or maybe even 30% of page impressions are now Reels, which haven't yet started to be monetized. So, I would say that's one where I'm still pretty optimistic. What about you?
Yeah, and well, what we've seen so far is Apple's action of disabling or requiring consent to tracking, but we have not seen Facebook's reaction yet. So they are rebuilding the advertising stack right now. They are investing in AI. Much of these data center investment that they have planned for last year and this year, 30 billion last year, 40 billion this year, 70 billion in total, are going into AI capacity, which help with analyzing the videos in the Reels. So what topics are they on, tagging them, and matching it with ads. So I'm quite optimistic that something great will grow out of that. I think the AI capabilities within Facebook or within Meta are nothing short of what we see at OpenAI with ChatGPT, but they just don't use it for a chatbot, they use it for advertising placement. And we will see that over the next year or so.
Yeah. Thanks for the question.
Another one from me, if it's okay. So for the 10 years of Business Owner Fund, you wrote one of the best letters I've ever read, I think, for the decade for the Business Owner Fund, and you documented the history of how you changed your styles over the years. And there's a paragraph in the letter that said that you are willing to change your style if the market, values less cheap companies. So you buy cheap companies, and you won't be, you will be able to sell the compounders and stuff like that. So, so I have two questions. Do you think that the market has changed, and now you need to change your style? And do you think that you are able to sell all of the companies that you value so much in order to manifest this change in style?
No, I wouldn't say that. I would say the style is really sort of being tweaked as opposed to changed. I mean, this was something I talked about in the letter from a couple of days ago. Every time you make an investment, you're learning something from it. It might hopefully be something positive, but it also might be negative. And then, of course, that flows into future investments. And that's the kind of the point I tried to get across in the 10-year letter. And I think that's something I tried to describe in the most recent one, where, for example, I mean, there's lots of different examples I could give, but, increasingly over the years, I've been more attractive to companies where the earnings are bigger but further out, rather than like having a relatively stable stream of earnings today and paying a low multiple for that. I'd rather look a little bit into the future and then pay an even lower multiple for earnings which are much further out. And that's still very much my belief. As an investor, you're just trying to buy cash flow as cheaply as possible, and I think by taking a longer term view, there's an opportunity to do that. But there's also drawbacks if you look too far into the future, because it becomes more uncertain. Lots of things can change. If there isn't a lot of cash flow in the present, that can also create problems. It can create opportunity cost if there's not an opportunity to buy back stock and all that kind of stuff. So I'm permanently sort of playing with the recipe and trying to figure out what is the right balance to strike. But I would say the broad strokes are pretty much set. And I love the companies we're invested in. If I thought they didn't meet those criteria, then of course I would sell them. But and one or two things I have sold. But in general, I like what we own. Yeah.
As to mistakes, I think, and how they should influence your investing strategy, I think there is a danger of learning too much from your mistakes, because we have a concentrated portfolio, and let's say we have one mistake every year or every second year or whatever, then if I changed my strategy all the time with every mistake, we would give much more weight to the recent past and not to all the times that this strategy may have worked prior to that. So it's a bit like playing roulette, and you bet on red, and black comes up and you say, damn, it was a mistake betting on red. And then you bet on black, and then red comes up and you say, oh, it was a mistake betting on black. So you have to always go back to when you made a decision to invest in, was it a mistake with the information you had available at the time? And if you conclude that, well, with the information you had available at the time, you made a rational decision, then it was not really a mistake.
Few questions from the internet, this time on Wix. Rob, what's your current view for the outlook of the company, and how do you feel about some of its spend on headcount, headquarters, other things over the recent years?
Yeah, I mean, Wix, I'm really very positive about. I don't pay too much attention to quarterly earnings. As you know, I'm trying to figure out what things look like in the distant future. That being said, I think there's a question mark around Wix and many of those sort of companies in that sort of tech space of whether the businesses really work and whether they're profitable. And I think in the coming few quarters, you're going to see some huge jumps in earnings in Wix. Israelis are known for being very aggressive and good business people. I think they were overly aggressive in the way they built out headcount and invested in the in the boom phase. But what I'm hearing is they're being equally aggressive now in the other direction of right-sizing the business and getting back to profitability. And if there's a question mark about whether that type of business is seriously profitable today, I'm pretty sure that won't be a question mark in a year's time. Anything you want to add on that?
I have no strong opinion on Wix, thank you.
I would like to ask if you took advantage of recent declining markets in increasing your shares or and if you are satisfied with enough cash that you were holding before this market drawdown, or you would like maybe to holding more cash before that. Thank you.
Well, it's very kind of you to draw attention to the market drawdown, but the portfolio drawdown was actually a lot bigger. So I think if it's just based off of the price action, probably there were bigger price moves within the portfolio rather than looking outside of it. So, the last year, as I wrote, I didn't add any new positions. I added to some positions, reduced some other ones a little bit, but I think the portfolio at the end of the year was not massively different from the way it looked at the beginning of the year. Yeah.
Well, I think also we are not holding cash by design, but we are trying to be fully invested, which doesn't mean that on the day we sell something, we immediately buy the next thing. But we don't want to hold cash because in general, there is an upward bias in the stock market and we don't want to miss out on that. And from that perspective, we will have good years since we are fully invested when the market is doing well, and we would have pretty bad years occasionally, and this is by design, but it should work out to our benefit over the long term.
Yeah. And the important thing is to have investors who are aligned with that, and in that respect, an enormous thank you to my investors. The loyalty has really been quite incredible. I think for every call I had about whether they should withdraw money, I think I had probably 2 on whether they should put more money in. So thank you for that. Yeah.
Hi Rob, thanks.
Hi,
and thanks for having me, and Andreas, welcome. My question is about culture. It has been a huge part of your investing strategy to figure out the culture of the company, that, like the employees, how they feel. With the recent changes in the tech future and the present, do you feel like there is going to be slow degradation, and how are you going to act on that, or what is your plan basically in that regard? Thanks.
Thank you, yeah. I mean, culture is incredibly important. For me, it's like an operating system for a company. You can't create a manual saying what to do in every possible situation. And so I think culture is kind of what gives people a sort of a lodestar, if you will, of what to do. And, the best companies' cultures won't change because of the downturn. What perhaps you will see is, I think, a lot of companies, when things are going really well and the share price is going up and people's stock options are going up, people will probably say, this is the best company in the world and we love working here and we never work anywhere else. And then, maybe things are going less well and some headcount is being reduced and stock options are not as worth as much as they were before. All of a sudden, they're like, oh, this company, they've lost it. They're no longer what they used to be and all this kind of stuff. And, for me, that is just sort of people responding to the, just to the stock market action. But that shouldn't change companies with really strong cultures. It won't change Ryman's culture that the share price is down this year.
Not much to add, but I think it also comes down a bit to what we said previously about getting to know management. So I think Rob and me, we ask ourselves, is this a guy I would want to work for? And because, if it's a guy that I don't want to work for, then it may be he may be creating a corporate culture that has people inside that work just for the money, not for out of some intrinsic motivation. So it really helps to Rob says sometimes be friends with the CEO, but I wouldn't put it like that, but respecting him and having a situation where you really want to work for this guy.
The kind of person you could imagine being a friend of. Right?
Exactly.
You don't necessarily need to.
Yes.
One at the back and a hand up in the front here.
Hi, I'm Arni from Italy. I wonder, regarding investing principles, what principle do you think it is true, but most investors, value investors and not, don't agree on?
Yeah, thank you for that question. I mean, it fits quite well with what we were last talking about. I mean, Andreas and I both think it's incredibly important to understand the people running a business and what motivates them, what their values are. And in fact, it might even be the most important thing to figure out. Obviously the business model has to work and all that kind of stuff. No one can make a business that doesn't work great. But assuming all that's the case, we really think people is the most important factor. And that's a controversial view. There are a lot of investors that don't pay attention to it. They think if you just make sure the incentive program is right, everything else will take care of itself. We don't think that. We don't think managers should be financially motivated primarily. Of course, they should be properly paid and they should enjoy their success, but that shouldn't be the main motivation. And there's a lot of investors that say you shouldn't meet with management even, because you shouldn't allow however they behave to influence your investment decision. And I just disagree.
Well, this is maybe where our styles are a little bit differently. I do think that I come away a little bit biased from meetings with management, but still they are important, and you have to correct a little bit for that positive bias. I always come away thinking they are good people. And so I made myself the rule that if I come away from a meeting thinking they are good people, they must be average people. And I have to come away really excited to put in my notes that they are great people.
Yeah. You wouldn't probably make an investment decision directly after a meeting, right?
No, never, of course, obviously. In fact, speak louder than words.
Okay. Anything non-management related which you think the markets miss, which you think is important?
I cannot come up with something ad hoc, but
have a think and come back to us. Okay. Any other questions? At the front here.
Hi. I had a question on Alibaba, which
Alibaba, yeah.
Mm-hmm. I think it was in the portfolio in the top 10 last time around, and isn't there right now? I mean, what are your thoughts on it? And have you exited the position, or?
Yeah, so Alibaba was a very small position, and I bought it with the intention of making a sort of a mini portfolio within the portfolio of Chinese companies. And so what I sort of envisioned when I bought Alibaba was, buying, probably one or two other companies as well. So it would have been sort of more of a probably 4 or 5 stocks, which I would view as quite concentrated in that it would have been a 5-stock portfolio, but obviously in the context of the overall portfolio would have been more diversified. And the reason I stepped back from that was it just didn't sit easily. I've always been a concentrated investor and always felt, if I'm not willing to put at least 10% in a company, then I should probably not put anything in. And, the opportunity in Prosus was, and possibly still is, so great. I didn't want to diversify out of Prosus into Alibaba. I think Alibaba is a very good business. I think it was and still is an excellent opportunity in the sense that it's a good business trading at a very low price. But I thought Prosus was a much, much better opportunity. Tencent has a better business. You had the value creation from the potential closing of the discount, which we didn't know at the time. We now know Prosus is being very aggressive in buying back stock to close that discount. The great thing about Tencent as well is it has this huge private equity portfolio. So when you look at the multiples of the company, which are already quite cheap, if you then bear in mind, almost half of the market cap at one point was in a private equity portfolio completely unrelated to the operational business. It was probably still is an incredible opportunity, and so I just wanted to have a huge position in that. So it was really more of an active decision for Prosus as opposed to a sort of a decision against Alibaba. Yeah. Andreas isn't a China fan, so I'm going to try and move on quickly to the next question. Do you have a mic? Or there's one there. Yeah, go ahead. Yeah.
Hi, thank you. I have a question about credit acceptance.
Yeah. So
credit acceptance has had a lot of new facts recently. So the first one was that they changed the way they fund. They went to one lender for 200 million allowance December, and that's opposed to what they used to do, which they go to the ABS market. And they have an extension of 24 months to 36 months, which that implies that they need to renew defaulted loans with new loans, and that loss goes to the equity, which that means is a lot riskier, the business today, one aspect. Second aspect, higher interest rates affect them a lot because they sell, like the interest rates that they give to the borrowers are at the highest in each state, so there is no margin on that. And third one, there are four. So third one is you have now, of course, the regulatory having a massive lawsuit for predatory lending practices. And several states are investigating that as well. And fourth, we are in a scenario where the second, or like the used car market is plummeting, and it's very, very challenging right now for several companies. So that means like when they repossess a car, they're going to sell it at a super massive discount. So these are huge facts for the company, especially for future earnings. Do they not move the needle for you to actually change, sell, or do something? If not, what set of facts, should they occur, would make you move the needle? Thank you.
Are you long credit acceptance by any chance?
I don't like it.
It sounds like you're not a fan, and that's fine.
No.
I am a fan. There was a lot of detail in there about sort of interest rates and used car prices and stuff. I think this is probably not the forum to go into that sort of very deep detail. I would say at a high level, though, I disagree sort of 180 degrees to the basic thrust of your argument, which was things are getting tougher for credit acceptance. I would say things, for the last few years, they've had sort of a headwind to their business. They're a very disciplined lender, and they had some really huge declines in the amount of new loans they were able to originate over the last 2 or 3 years, because in a very hot market, there were lots of new entrants coming in, making crazy loans at crazy prices. And that situation's clearly changed in the last 6 months, and we're now entering a market which is fantastic for credit acceptance. So, higher interest rates, of course, all things being equal, is bad for any lender, but things aren't equal. Credit acceptance has a 30% of its book financed with equity. A more typical lender might have 10%, so they're much more affected by increases in interest rates. So while it might be in an absolute way bad for everybody, on a relative basis, it vastly improves credit acceptance's position. Ditto for repossessing the repossessed cars which get resold. If you're repossessing a car and selling it for less, then yes, in an absolute sense, that's a negative for the business. But in the sense that other players are much more negatively impacted by that, it's a very strong tailwind for credit acceptance business. So I think we might have to agree to disagree, but I do think this year you will see very, very strong growth in originations from credit acceptance. I mean, that's already clear. There may be a little bit of turbulence on some of the older loans where maybe they collect a little bit less than they expected, but I'm pretty sure that will be overwhelmed by getting much better economics on the new loans they write. And you saw that in the financial crisis in 2008, 2009. From memory, in which everyone will remember was a disastrous situation for any kind of subprime lender. From memory, I think they doubled their earnings between the start and the finish of the crisis. So this is a business that really does well when times are tough. Just taking a little bit of a feedback on the mic. I don't know if we should turn to. Okay, thanks. Yeah, do you want to go?
Thanks, Rob and Andreas, for hosting. Rob, you mentioned that you feel probably better about Facebook's prospects today than you did a year ago, and you didn't just mention the valuation difference, you also talked about a headwind that's abated. And as you look across the portfolio, are there other names where either headwinds have abated or maybe new headwinds have come up and that have sort of changed your investment hypothesis over the last couple of years? Thanks.
Yeah, I mean, this is something I kind of tried to address in my half-year letter, where I was like, when there's a big drawdown, the question is, okay, which ones is because you think the intrinsic value is really down a lot, and which is where the market has maybe just sort of turned, more unnecessarily pessimistic. And I think we talked about Prosus, we've talked about Meta. Credit acceptance. I think these are all examples where the market has turned more negative, and I don't share that. What about you, though, Andreas?
Well, I think the market is certainly more rationally priced right now than it was in a couple of years. Though we are not in distressed territory. It's not like 2009 or 2003 all over again. So, yeah, it's somewhere in the middle, normally priced.
Yeah, which is where the market is most of the time, right? Yeah. Who's got a mic? I see lots of hands. Okay, great.
Hi guys, thanks for having us here. I had a question around how you prioritize your reading time. So how much is maybe current companies in the portfolio versus new ones you might be interested versus studying new technological trends or reading history books and biographies, and how has that changed over time?
I think there's sort of a cadence where there tends to be a lot of information around quarterly earnings report time on companies you're invested in. So I would say that takes up, around that quarterly earnings season. I don't pay too much attention to quarterly earnings, but like a sports fan, I kind of want to see how our companies are getting on, and also, of course, potentially there could be some very good or very bad news in a quarterly earnings report. So, I would say in that sort of those 2 or 3 weeks where there's a lot of quarterly earnings, that takes up a lot of the time. And then in the remainder of the time, it's probably, divided more equally between existing and new opportunities, doing calls with experts, doing the kind of basic research into industries, talking to new company managements, all this kind of stuff happens probably that remainder of the time, yeah. How about you?
Yeah, of course, also it depends a bit on what new markets open up, what new technologies become available. I spent a fair bit on ChatGPT, for instance, because it sounds like a technology that could influence a lot of public companies, and including the ones I hold.
Maybe you should say what ChatGPT is in case people aren't familiar.
That's a neural network that was developed by OpenAI, and it's a chatbot. You can enter some query into that, and it will answer in text. The answers are quite impressive, I would say. You cannot easily say that this is a robot that you are talking to. It may just as well be a human. And this is just the beginning. In 5 years' time, we would have a much better. I was playing around with GPT-2 a couple of years ago and was training it on the Buffett letters and telling it to generate a new Buffett letter out of that. And the result was not very impressive at the time. But what I've seen so far with ChatGPT was really impressive. And
for me, it was like an aha moment. I remember very clearly when I was in, I think it was my first or second year of university, and would have been, I guess, 92, 93 or something like that. And someone from the computer sciences lab called me up to the room and said, "You've got to see this, you've got to see this." And he uploaded a web page, and it sort of slowly, this web page sort of literally one line by line, the pixels built up until there was an image on the screen. Given I was a student at the time, I'm not going to say what that image was. It was that aha moment where you saw, wow, text and video and all that kind of stuff. It's incredible. It was an incredible aha moment. And for me, something similar happened when I saw ChatGPT for the first time. It's uncanny how the responses are. Really, if you haven't tried it, I would recommend it, yeah.
Yeah, so sometimes there is more happening on the technology front. You spend more time on that. And sometimes there is not much happening. Sometimes there's more happening with your own companies. So I don't really measure how much time I allocate, but I would say maybe roughly 2/3 towards existing companies, including developments that may potentially affect existing companies. So I'm no more an investor in Alphabet, but I was, and so ChatGPT would certainly be an even bigger allocation of my time if I still was invested.
Okay. Yeah, do you want to?
Thanks, Rob, for all the interesting talks. Just a question on management and kind of reputation risk. Your 15% objective return, do you think there's part of that comes from being willing to take on bets on companies like credit acceptance, or in this case Meta, where the market is very against, these people are doing bad things, and you have a different assessment to the market in terms of what they do to generate value for their clients, and there's an arbitrage, shall we say, in terms of that, the results of the work that the company does versus what the market thinks that they're doing. I don't think there's any company that has such a bad reputation as Meta, Facebook, amongst any commentator, that they're evil and they're doing terrible things, and yet the company makes money.
Yeah, I mean, just to be very clear, it's not like, I wouldn't invest in a tobacco company on the basis that, hey, a lot of people are going to get killed, but we're going to make a lot of money. So, if I'm taking a position in Meta where clearly there's a lot of negative press about the company, it's because I think, I disagree with that. I disagree very strongly with Meta. We've talked about it in prior years, but, I think there's a tendency when the internet does lots of good by connecting people together. Us all being here today is an example of that. And when good things happen, it tends to be because of internet or people and all that kind of stuff. And then when the bad stuff happens, then it's sort of Meta tends to be the one that gets the blame for that. And and I think you have to accept that it's a trade-off, right? By connecting people at scale, a lot of good happens, much more good than bad, but there is also, unfortunately, some bad. But everything in life is a trade-off, and the people who just sort of point to the bad, ignore the good, don't even acknowledge the trade-off that if you wanted to get rid of the bad, you would have to also get rid of the good. I think they make life very easy for themselves. But the acid test is, I think a company which genuinely does bad things would disappear over time. One way or another, it would disappear, and it would turn out to be a very bad investment. To the extent a company is perceived as doing bad things, but actually is a net positive for society, you'd expect that company over time to prosper. Yeah.
I may also say some of the things that we live in a very politically divided time. So one party says you should censor more, and the other says you should censor less, and there are no clear rules on how much Meta should censor their platforms. So they have to find some compromise, but they cannot make everyone happy. So if they censor something, one party will say you censor too much and you're a bad guy. And if they don't censor something else, then the other party will scream. You cannot make it right for everyone. So I think that I would wish for there being clear rules, but there aren't.
Yeah, and it's not by coincidence there aren't, because politicians are much happier to put the blame onto Mark Zuckerberg. To the extent someone did lay down the clear rules, then that blame would then be shifted onto them. And so that's why probably we're just going to have to learn to live with the situation as it is. Yeah.
I would like to ask, what is your overlap in your two portfolios? And if you are challenging also performance between you. What is the overlap, your positions?
There are two companies currently overlapping. One is Meta and the other is Salesforce.
And what is your performance compared to RV Capital?
His is way better. I've had to work for a living. He's compounded his capital just by managing his own capital. So there's no competition there, I'm afraid.
It's not that much better. I mean, I'm also down a lot last year. Not quite 50, but maybe 30% in euros. Yeah.
I have a question regarding ChatGPT, because I also spend a substantial amount of time checking it out. And I was wondering, how, in the end, in the next couple of years, knowledge work will tend towards the processing power needed to produce the output. And what socio-economic impact will that have on society, making a large part of the population useless in terms of work as we know today? And the second question is maybe related to Wix, because I had ChatGPT, for example, generate HTML and PHP code in a matter of seconds. Do you think that would, for example, strongly impact the business of Wix, where I can just talk to ChatGPT and have it create a website with content within minutes or seconds?
Yeah, I read a wonderful book on a little bit on this related to your question. I forget what the name was, but it was about the use of energy since the very start of civilization. And if you think about us as a human race, we started off as hunter-gatherers, and we basically spend the whole day trying to find seeds and plants or whatever, and expending all our energy on that. And then various developments came along, so they, man or people managed to sort of harness animals, and then having harnessed animals, someone invented a harness, and then they improved on the harness. And so as a species, we've sort of been getting more and more efficient. And if you fast forward to today, where, I think probably less than 1% of GDP in developed economies is spent on agriculture, the reason we're so efficient is because we've managed to harness energy and, of course, machines and all that kind of other stuff to do the hard work for us. And that has been a huge net positive for society, and will continue to be, and GDP and all this kind of other stuff is all part of that overall development. That being said, there's always people that get left behind when these sort of technologies come along. If you worked in agriculture, 100 years ago, and then tractors or whatever it was came along, then you probably lost your job, and to the extent you didn't know anything else, then that probably wouldn't have worked well for you. So as a society, our job is to make sure people who don't benefit from these changes get properly looked after, so retrained ideally, or given a safety net if not. But it would be a huge mistake to try and slow down these things that make us more productive, because that's ultimately the driver which increases the overall pot and makes us as a species more wealthy, even though that's not always fairly divided. Yeah.
Well, I think innovations like ChatGPT just increase productivity and make us all do more work in less time. There is an old joke: two people are standing at a construction site and watching an excavator digging a hole in the ground. And one person says to the other, well, this excavator made 100 people with shovels unemployed. And the other says, yes, or 10,000 people with spoons. So, yeah, you always had innovations that made people more productive, but still the unemployment rate is not at 99% right now, but it's pretty much where it always has been, with some fluctuations, of course. And I think the same way of ChatGPT. It's not like it can already replace a human. Maybe in a few years, I don't know. But the human will have to move on to other things that ChatGPT is not as good as.
Yeah. Ferdi.
Yeah. Maybe a bit unfair question, but I'm interested in your different views on China. So maybe, Andreas, why don't you like China, and maybe Rob, where do you disagree?
Well, I think you all know I'm very positive on it, so I'll let Andreas give you the other side of the coin.
Okay, I've had one investment in Australia, which was a company that was developing a gas field in China, and you could easily calculate that the company was deeply undervalued, maybe worth 10 times as much as it was trading on the stock market. And I came out with a significant profit out of this investment, but it could have gone a completely different way, because as I learned later, they have had contracts with state-owned enterprises through which they sell their gas to the end customer. And whenever the economics turned out to be better than the state-owned company wished for, they shut off the cash flow to them and forced them to the negotiating table and renegotiated the contract. And that happened 9 times in 10 years. So as an investor, you cannot just look at the contracts in place and the gas in the ground and things like that, how you would act in a Western society. But the whole political element plays a huge role. And I just find it introduces too much complexity to my investing life. I have 10,000 public companies in the US and 5,000 in Europe, and if there's nothing within these 15,000 companies, then maybe I'm better off waiting half a year for something to come up rather than going too far out of my circle of competence to look for things.
Yeah, I mean, I wouldn't disagree with any of that. From my perspective, I don't think China is well understood in the West. People are generally negative about it, perhaps in some part for good reasons because they have a different system. But that's a system that works very well for the people there. I think that doesn't get reported on as much, and the people as a whole are pretty supportive of it. It's a very different civilization with a very different history, and it's quite difficult to compare it to the West. And when I look over there, I see an economy as a whole which is developing very rapidly, and within that economy, companies which are developing very rapidly. And as an investor, and clearly the political risk is much higher there than it is in the West. But I would argue so is the opportunity, not just in terms of the earnings development, but also in terms of the price you pay for those. And so for me, that kind of risk-return matrix makes sense, but everyone will reach their own kind of conclusion about that.
Few questions from the internet on Salesforce for both of you. In summary, how do you feel about the leadership shakeup, and what's your outlook for the company?
How do I feel about?
The leadership shakeup, and then growth prospects going forward, outlook.
Yeah.
Take it where you like.
Yeah, obviously you want continuity in your leadership. It's a huge disappointment if so many people leave the company at the same time, and even they have to restructure. And so from what I read about the situation, the takeover of Slack was not orchestrated as well as it should have. The integration and also the checks you made before the acquisition. And in terms of the restructuring that was recently announced, they let go of 10% of the people. They just hired, according to their revenue growth in the past, rather than incorporating the outlook of how revenues might develop going forward. So they had just hired too many people, and unfortunately.
Yeah, I mean, I don't think the development has been great from an operational standpoint over the last probably few years. But I think these things have a silver lining. Salesforce is a very well-financed company. Has zero financing issues. Its end product, which is a software which companies use to manage their customer relationships, it's like a utility. It's virtually impossible for them to tear it out. And so, a crisis at a company like this is probably on balance a good thing. It's a little bit painful to go through it as an investor, but clearly they're going to shape up. They've announced they're going to cut headcount by 10%. That might not be the end of it. And just to be clear, I'm not a fan of headcount cutting in any respect. Ideally, companies shouldn't overhire in the first place. In this case, it's in one of the wealthiest regions of the US where people have lots of opportunity to do other things. So if they're sitting around doing nothing, I have absolutely no problem with them being invited to go and do something else. You want to say something?
Yeah, I disagree a little bit. That I think that Salesforce has done well operationally over the years. They just recently slowed down a bit because of the economy, because of currency translation effects. Currency translation effects are probably now a thing of the past, and the economy will recover, and it's just a normal thing that every few years we have a recession, that every analyst should incorporate that in his analysis. So I'm not disappointed by how things are developing at Salesforce, but Yeah, so I think certain mistakes had been made with Slack, and that's the only thing I wanted to express.
Yeah. No, I agree with that, and they were obviously losing discipline financially, and I think that's probably in the past now, right?
Yeah, I hope so. I mean, they communicate that they want to get operating margin up, and I think a high operating margin is not just something that can be derived from competitive advantages, but a management team also has to want it and has to make it a priority for them, otherwise it won't happen.
Yeah, this week actually we were in Copenhagen at a conference, and we saw this company called Lime Technologies. It's a CRM company with a software which is almost identical to, well, in terms of the basic functionality, identical to Salesforce. And the company had, so the company has like about 50 million euros in annual revenue, so probably about 1% of Salesforce's, and the operating margin was what, 30% or so?
Yeah, it was operating much more profitably. Yes, it's true what you say. I mean, maybe a little bit more than 50 million in revenues. But
okay.
Yeah, so less than 1%.
A tiny company, and making margins that Salesforce could only dream of. So I think there's going to be a lot of improvement there, I think, in the coming years.
Absolutely. I also like Salesforce verticalization strategy. I think this could lead also to much higher margins.
So Andreas, I warned you, it would go by quicker than you think. At least that's how I always experience it. It's 5 to 12, so we've probably got time, depending on how quickly we answer, for one, maybe two questions. Should we do maybe one from the audience, one from Nick, or what do you think? Two from the audience, okay. So who has a mic?
Go ahead. So one of the things I find interesting in your portfolio is I sort of see two kinds of investments. On the one end, I see companies like investment cases like Google or Salesforce, where the company is obviously pretty good. They've done so many things right, and you can distill the investment case into like a sentence, like discipline. And then on the other end, there are a lot of smaller companies where the moat is largely around culture, execution, and they're working towards it. But these investment cases are messier, and there's a lot more moving parts, like Ryman, for example. So how do you think about, it almost is sort of a different mental reflex to own both kinds of companies. So how do you sort of think about that?
So just to summarize the question, it was like some companies have very complex investment cases, and others it seems more clear cut, or
something to that effect.
Not sure I 100% got the question, so feel free to chime in if I'm on the wrong track. I mean, I try to make sure the investment cases are very simple when I make the initial investment, and I explain the cases in my letter. When I write the letter, I always imagine the person reading it as someone, not an expert, but someone with a decent understanding. But the case should be sufficiently clear that a non-expert would approximately understand why the investment is being made. So it's not the intention that the cases are, look to have too many moving parts or something. I think maybe what you're referring to is, some of the companies have overinvested in the boom years and are now sort of like trying to work their way through that, and so maybe that's some of the sort of the noise you're referring to. That's I didn't foresee that at the outset. In hindsight, it was probably inevitable, but that was certainly not the reason to invest in them. But having now being invested in that situation, you make an assessment, and the price is obviously down a lot. Can they get through that and get back to where they were? In which case, you would expect the share price to get back to where it was, and then hopefully continue upwards from there. Or are the problems insolvable? And if I think the problems are insolvable, then I'd most likely sell the company. But if I think it's transitory, then I'd be willing to kind of sit it out. Yeah.
I agree, and I would say a short-term misalignment of revenues and costs is not affecting the moat of the business. So it's important to make sure that the moat is intact, and costs and revenues will align in the long term if the management is doing the right things. And in general, I prefer simple cases. It's a much higher probability that the case will turn out in your favor if the case is simple.
So it's 2 minutes to 12. So given that I had a little bit of a spiel at the beginning, we're taking one last question. Yeah. just over there, yeah.
So I don't think it's controversial to say that over the past 5 years or so, the market at large has narrowed in favor of certain sectors and certain investment approaches. You mentioned earlier, Rob, tobacco, but as a result of things like ESG, there are a number of other sectors that I would think of, commodity sectors, mining, energy, that have fallen by the wayside, not only in terms of investor favor, but also capital coming into those industries. I often think of you as being a growth investor alongside a quality investor, and many of these industries will be growth investments going forward, and we're seeing that with some of the structural trends towards the need for copper, for example. So how do you think about what is investable to you? Because certainly I think a lot of institutional fund managers have taken great pride as calling some of these investments or these sectors as not something they typically do.
You know, I mean, just to be clear, I mean, I'm not a big fan of a lot of this ESG stuff. I am a big fan of society having problems and we needing to find solutions to those, but it really strikes me a lot of the time that a lot of the ESG sort of ideas are really heading on the wrong track. And, you know, to speak specifically to kind of commodities and oil producing companies, I'm a big fan of commodities being produced, of oil being drilled. You know, I spoke earlier about society's development, and that's only possible because we have energy we can harness to do this stuff for us, so we don't have to do it ourselves. And you know, I've never really felt a strong affinity to oil companies. You know, the big ones tend to be quite big and bureaucratic, and you know, the smaller ones are, you know, tends to be quite a few sort of dodgy operators in there. So I've just never felt a huge affinity, but philosophically, I'm very open to investing in that space. Andreas mentioned he's invested in a gas company before, so I'm very open to it. And I wish there was a bit more, you know, joined up thinking in the markets. You know, I read an article the other day, which in the same newspaper article, I think it was in The Guardian, complained about the rising oil prices. And then, you know, the strain that was putting on families and all that kind of stuff, at the same time as complaining about the amount of money oil companies are still spending on capex. You know, you could be anti-oil, but then you have to be in favor of the price going up a lot for what's remaining, or you could be pro lowering the price, and in which case in favor of drilling for more of it. But you can't. You have to at least acknowledge those trade-offs. And a lot of the ESG crowd, in my view, don't acknowledge those trade-offs. Yeah.
Well, when it comes to natural resources, typically these are very capital-intensive industries, and I'm not super competent in them. So maybe you should know where your circle of competence is and then stick to it. It doesn't mean that you cannot occasionally do something that is borderline if the margin of safety is big enough, and I concluded that this was big enough with the gas company 7 years ago. But it is quite the unusual was quite the unusual investment for me at the time, and typically I would not do it not because one shouldn't do it, but because it's not the right thing for me and for what I know.
Great. So we're a couple of minutes after the hour, and the sun is shining here unexpectedly. I know a lot of you are keen to hit the mountains, which I would really encourage you to do. Just to recap, Andreas, we're going to hang around here and talk a little bit longer, but after half an hour, 45 minutes or so, we're going to both head up to the mountains. I'm more of a skier, so I'll be orientating myself towards Nate and the Powder Hounds. Andreas is more of a walker, and so he'll be going for a walk, and so feel free to tag along. Andreas, congratulations to you for doing the first Q&A. It was wonderful.